Welcome everybody to our webinar based on the report, the ECB Strategy, the 2021 review and its future. My name is Tim Phillips and I'm going to be moderating for the next 75 minutes. We're with you for an hour and a quarter today. We're going to be discussing the CEPR's shadow report that was written in parallel to the official strategy review that was conducted by the ECB. The CEPR report was published this month. And as the report says, many questions remain unanswered in the ECB's review. Well, we can guarantee that in the next hour and a quarter, we'll have answered all of those questions. Now, if you want to read the report, you can download it. It is free to download, and I'm just going to stick the link to that in the chat in a minute. You might want to download it now and read along while we present today. More practical, probably download it, save it for later, and catch up. There is also, if you like the idea of the report but couldn't eat a full one, then there is a column on Vox EU, also called the ECB Strategy, the 2021 review and its future. Now, what are we going to be doing today? We have 4 panelists with you who are also authors of the report, and they will be presenting. I'm just going to say hello to them just to check that the microphones are working. So first of all, Lucrezia Reiklin from the London Business School. Lucrezia, hello.
Hello, Tim. Hello, everybody.
Klaus Adam from the University of Mannheim.
Hello to everyone.
Ricardo Reis from the London School of Economics.
Hello there.
And finally, Beatriz Veda Di Mauro from the Graduate Institute Geneva, INSEAD, and of course she is the glue that holds the CEPR together. Hello, Beatrice.
Hi, Tim. Hi, everybody.
Now, it's a pretty simple format today. In a minute, Lucrezia is going to do an introduction. There are 4 chapters in the report. And Klaus is going to talk to you about the first one, Ricardo the second one, Lucrezia the third one, Beatrice the fourth one. They've been given strict instructions to keep to time, which means there'll be time at the end for you to ask questions. Well, I don't ask questions just at the end. I would advise you to get your questions in early. Use the tab at the bottom, the little Q&A button at the bottom. And you can use that to type in your question. You can also use that if you go along and have a look at the questions and see one that you like. You can upvote it. You can upvote your own questions as well, and nobody will know. The ones that get to the top are the ones that get asked first. If you leave your questions until the end, they might be at the back of the queue and never get asked, which will be frustrating for you. So I'll get out of the way now. And first of all, I would like to turn over to Lucrezia, who is going to introduce the report. Lucrezia.
Thank you, Tim, and good afternoon, everybody. As you know, in July this year, the ECB announced the completion of its strategy review. And this is an important step. In the last 15 years, the ECB had to fight 3 big crises. And much has changed in the economic context since the inception of the euro, but also much has changed in the, in monetary policy as it is actually implemented. Now, contrary to the skeptics, the euro has survived. But as we know, the objective of price stability has been, less successfully pursued. And, if you can show me the chart, Tim, that would be helpful. Here you find that the HICP price index in blue, this is the level, the price index, since the inception of the euro. And in red, you find the level that we would have observed if the 1.9% target, just below 2%, would have been achieved since 2008. As you can see, there is a big gap since 2012. This is, of course, after the euro area debt crisis. So the ECB was less successful than other central banks in achieving its price stability, its inflation target. Now, the main question in analyzing, in reading our review and in reading the ECB review, the main question that everybody has to ask is whether the new framework will deliver and will deliver in, making sure that, the 2% price stability objectives is achieved, and also to continuing to assure the integrity of the euro. So, we acknowledge in the report that much progress has been done with this strategy review. We look with we favor we think it's a very good idea to have introduced a single numerical value from the inflation objective. Now it's 2%. To have introduced the symmetry around that objective. So that means clarifying also that the ECB is willing to tolerate deviation from their target temporarily. And also, we welcome the clarification of the forward guidance and also the announcement that the new tools are going to stay for now in the operational framework, although there is a level of ambiguity of what's going to happen in the future. It is very important also climate change consideration in the monetary policy strategy and also a commitment to a roadmap on climate-related actions for monetary operation. We very much welcome that. But also, as Tim has already anticipated, the report make the point that many issues remain unanswered and maybe some of the answers are not quite the ones we would have liked. So what is our report trying to achieve? We aim at establishing a framework on the basis of which we can have a discussion for this review, but also for the future review. And this is why we title our shadow report, the 2021 review and its future. So the CEPR will keep on monitoring developments in the ECB strategy and policy. This is, of course, a very important pillar in the EU project. And with that, I just give the floor to Klaus, who will introduce the first chapter.
Yes, Klaus, yes, for the chapter 1, please.
Yes, so welcome everyone. So I want to talk first about the objectives of monetary policy. And that, of course, means foremost the price stability objective. I think, as Lucrezia alluded to, a lot of progress has been made. And we have certainly come a long way since the last strategy review of the ECB in 2003, and also since the inception of the ECB. Let's not forget the ECB initially had to establish its inflation fighting credibility, and as a result, just set an upper bound on what price stability means, namely something below 2%. And then following the deflationary pressures of the associated with the bursting of the dot-com bubble, clarified that how far below 2% it means, namely it meant above 2%, above 0%, and then set an inflation objective in that 0 to 2% range of close to but below 2%. That had a number of issues. It suggested that deviations to the top were considered differently than deviations of inflation falling short of the below 2% objective. And all these things that sort of have historically had its merits have been now clarified, and we have now a single numerical target of a clear 2%, which provides some focal point on which we can coordinate expectations, and we certainly welcome this. There have been a number of other additions to the strategy with regard to the inflation objective. The ECB has committed to a more forceful reaction, in particularly to disinflationary shocks, and that is also certainly welcome. And it has also sort of said or stated that it would tolerate a temporary and moderate overshoot of inflation above the 2% target on the trajectory of getting in the medium term back to 2%. So this is also very much welcome by us, but there are a number of unresolved issues from our perspective. So let's start for one, the numerical objective itself of 2%. We could not find any quantitative analysis that would allow us to get at why the ECB arrived at the 2%. There were a number of important structural changes that happened since the last strategy review that we would like to have seen a quantitative analysis of these and what they imply for the inflation objective. There is a downward trend in the natural rates of interest, that is the real interest rate that are consistent with price stability. There have been important changes in other areas of the economy. For instance, we have learned how stringent the lower bound constraint on nominal interest rate is, that is the inability to go significantly into negative territory with nominal interest rates at the deposit facility. And as a result of that, we feel that there is little grounding for the discussion on future reviews of, how we should think of, according to what criteria the ECB might ever, if ever, adjust the target. We also think that the 2% target is perhaps at the somewhat lower range of plausible values that would come out of an analysis that seeks to determine the optimal level of that should be targeted. The second thing that we find not so convincing is that the ECB, unlike the strategy of the Federal Reserve, has no clear make-up strategy following disinflationary shocks. While the ECB stated its willingness to tolerate a temporary overshoot of inflation in bringing medium-term inflation back to target, it does not in itself target such overshoots. And we think this has profound implications for the ECB going forward of achieving the 2% target. Because if it so happens that there is no overshoot in going back, and given that shocks that lower inflation below the target have stronger effects because of the inability to lower nominal interest rates significantly into negative territory, this means that these negative shocks will have stronger implications for inflation than positive shocks. And we still think that too low inflation, despite the temporary high inflation rates currently, are the main problem going forward. In particular, the low value of the natural rate of interest, the real interest rates consistent with price stability, and the value of 2% for the inflation objective chosen will mean that nominal interest rates will continue to be low, and the ECB so likely going to continue to be constrained by the inability to go into negative territory. So one possible outcome that we fear as a result of this strategy is that we will continue to see target misses of the kind that Lucrezia documented have happened after 2012. Okay, so then more broadly speaking about the objectives of monetary policy beyond price stability, the ECB has a number of other objectives to which it offers support according to the treaty, and it clearly acknowledges this in its strategy review. These include, of course, the desire to preserve financial stability, the general desire to contribute to a balanced real economy, and also its desire to continue to the new the new objective of contributing to fighting climate change. Now, we think that with regard to these different objectives, there are a number of unresolved issues. First, the review somehow pretends the absence of trade-offs between these objectives. And this we find a little puzzling. So the review speaks of financial stability being a precondition for price stability, and price stability being a precondition for financial stability. It also speaks of price stability being consistent with a balanced real economy. And it says that climate change objectives can be pursued without affecting price stability. Now, this may all be true, but we think that there's a serious risk of stark trade-offs possibly lying ahead. And this is a problem because then the guidance that we have from the strategy is simply absent on how to trade off these different objectives. So one thing we could easily envisage is that, which is now in financial markets participants' minds, is that inflation dynamics prove to be stronger than currently envisaged, more persistent than currently envisaged. And then we could easily see a situation in which the need to increase interest rates in order to fight those developments comes into conflict with the desire to preserve financial stability, given the asset market valuations that we see and perhaps the conditions we see in some of the bond markets. So what our report proposes is an integrated framework on how to coherently think about these different objectives, at the same time acknowledging that the primary objective of the ECB is and should continue to be, according to the treaty, the pursuit of price stability. And the logic that we propose is very simple. It says that the pursuit of price stability and the instruments that need to be deployed in order to get there at the medium term may entail costs in terms of these secondary objectives. So for instance, the need to get price stability, to get inflation up to the target in the medium term requires very low interest rates. And as a result of that, may generate high valuations in asset markets that create risks for financial stability. If this is so the case, that the secondary objectives, in terms of the secondary objectives, these instruments create risks, then this would justify longer horizons for the achievement of price stability. Conversely, if we have secondary benefits in terms of achieving medium-term price stability, for instance, a more balanced real economy, lower unemployment rates given high levels of unemployment, then this would justify deploying the tools more forcefully and therefore bringing forward the price stability objective in terms of its horizon. So far, my short summary on chapter 1, and let me now hand over to my co-authors. Thank you.
Thank you very much, Klaus. Ricardo, I believe that you are talking about chapter 2.
That's right. Thank you very much, Tim, for the introduction. So chapter 2 talks about the tools of monetary policy. Now, for those of you who had, say, a secondary education in economics, you will think of central banks as choosing money, printing currency, whereas the majority of you who follow the financial press or even just the common news will think of central banks as choosing interest rates, as setting the interest rate, whatever that means. Now, over the last 10 to 12 years, the ECB, together with many other central banks, has introduced a series of new tools to monetary policy. And so, again, most of you who follow the news carefully will now have heard of quantitative easing, central bank balance sheets, outright purchases by the ECB, refinancing operations, discussions of negative interest rates, forward guidance, and the like. The last 12 years have been, since the great financial crisis, that is past 2007-8, there's been a great amount of innovation, not just at the ECB, but also elsewhere. What that means is that when talking about the tools of monetary policy, one can no longer just talk about printing money or setting interest rate, but has to be considerably more precise. In the case of the ECB, we think this is quite important because of its young life. For an institution that is only a little over 20 years old, the fact that now more than half of that life has been conducted under a regime that is still today referred to as unconventional, extraordinary monetary policy is, we would argue, inadequate. After all, if more than half of your life you have been doing something, conducting policy in a certain way, communicating about your targets and your tools and what you do using a particular set of tools, then it strains your credibility to keep on referring to that as being exceptional, unconventional. Moreover, not only strains their credibility, but also normalizing these actions would be important to set in terms of the discussions, whether they are legal, conventional, political, of what should be the norm of what a central bank do. And as importantly, it seems to us likely, to the authors of this report, it seems to us likely that we will not go back to the pre-2007 world, that is, that these new tools will stay with us. Therefore, our first main recommendation is that the ECB embraces that there is now a new normal, normalizes operations, describes clearly what it does today. To a very large extent, the current review did that, although it could have gone so much further, and that is what I'll be talking to you about over the next few minutes. But most importantly is this message that a new normal must be established so that credibility, norms, not always trying to revert to the past is established within the Eurosystem. What are the features of that new normal that we think not only have existed, but especially are desirable? In our chapter, we review some of the effectiveness of some of these different policies to conclude that where it continues to be an economic challenge that requires research to really pinpoint the individual effectiveness of each program. Although the research of the last 10 years and the experimentation or the changes in policy that have occurred in response to events do allow us to make some progress in it. We do not try to catalog all of those changes. This wonderful book, for instance, by Massimo Rostagno and co-author just coming out, or a previous article by Philip Hartman and Frank Smets that you can refer to if you want a more historical account of what were the many different changes that have happened. We instead try to focus on what are the changes that should stay and should perhaps extra change that should happen in establishing again what the new normal is. Let me state those in terms of 5 principles, or if you want, 5 headings. The first one is that these, beyond setting the short-term interest rate, the outright purchases, the refinance operations, the negative interest rates, and the forward guidance should be seen both as complements and substitutes to the short-term interest rate. We say complements because these different tools have effects on different margins of the transmission of monetary policy to the real economy, as well as different effects on different variables that, together with inflation, influence the objectives of the central bank that complement each other. It has often long been said in discussion of central banking that the interest rate is a very blunt tool to achieve multiple objectives. Indeed, but now that there are 4 or 5 different tools a central bank can use, that bluntness can be, if nothing else, reduced with the sharpness of having multiple tools. But they're not just complements, but also substitutes. In a scenario like Klaus was just mentioning, that where we expect real interest rates to continue to be low under the conditions of what is sometimes known secular stagnation, and with an inflation target like Klaus noted, remains unchanged at 2%, although perhaps it should not do so, it will become increasingly likely that the short-term interest rate becomes very close to its effective lower bound. And in those circumstances, these other policies are substitutes to short-term interest rates in terms of control for inflation. So acknowledge that these are neither substitutes only nor complements only, but both is a very important first step. However, in doing so, it becomes even more important to have a normalizing framework in which to explain how they complement and substitute each other. In this regard, we suggest that the ECB should communicate the combination of these different policies and their intended effects more and more through their effect on prices as opposed to quantities. And so less of how many more million of outright purchases and more of what effect do we hope that will have on prices. What prices in particular? Well, the ultimate objective is, of course, inflation, but the intermediate target of every central bank is ultimately the interest rate. And therefore, we propose that the ECB continues that norm of communicating in terms of interest rates, but extends that to not just the short-term interest rate, but the entire risk-free yield curve, that is the entire sequence of interest rates of different maturities. That is, that policies are discussed more in terms of what are their intended, predicted, or desired impacts on the short-term interest rate, the 1-year rate, and the 10-year rate. So that's the first thing. And this creating a framework and anchoring that framework in terms of an indicator, and we propose that the risk-free yield curve would be the right one for the ECB. Second one, that when it comes to the monetary policy tools, that the main short-term interest rate should stop being the main refinancing operation rate, but rather the deposit rate. What do we mean by that? We mean that that the ECB should start saying the rate at which it pays banks to have deposits in its balance sheet as being its, if you want, main short-term interest rate. There are many virtues of doing so. A main one being that that's a rate that the central bank, the ECB, controls, that the ECB sets directly, and that affects directly the costs of finance, the alternative opportunity cost of financing for banks and through them to the rest of the economy. Forward guidance, refinancing operations, active lending policies like the PEPP can then be discussed in terms of affecting the yield curve going long, meaning in terms of their impact on the 1 and 10-year rates and 5-year rates. Okay. So in terms of the monetary policy tools, and our second point is, 1, the deposit rate of the short end. 2nd, then discuss the other policies in terms of their effect on higher maturities, longer maturities. Third point, when it comes to liquidity, there should not be a strict separation between liquidity policies and monetary policies. They are complements to each other. But focusing on liquidity policies for the sake of this very short presentation, that first important principle is that the ECB's balance sheet continues to be large because the demand for deposits at the ECB seems to be higher than it was envisaged 20 years ago. And it is an important part of monetary policy to supply liquidity elastically to the markets to be able to guarantee that there's an abundance of means of payment that do not constrain economic activity. So a large balance sheet will remain, but judging that should be again in terms of prices, in terms of whether we see that interbank rates are close enough to those deposit rates. Related, that when it comes to the lending programs, the ECB has for now, well, since its inception, been using credit agencies to evaluate the desirability or the acceptability of different forms of collateral. We think this is a dangerous thing to do. After all, it is the nuts and bolts of monetary policy that the central bank can choose how to guide its policies. Making that reliant on private credit agencies seems to us a mistake, and we suggest that it should be replaced. And finally, when it comes to liquidity, it has become a little too common to use the ELAs, the emergency liquidity assistance that national central banks do. We advise against so insofar as it leads to a fragmentation of monetary policy and the centrality of decision-making at the ECB. So we're not saying that not all of the unconventional last decade should be normalized. Some should perhaps be, if not discontinued, at least used much more sparsely than they have been in the last few years. Fourth point, lending facilities. LTRO, swap lines, and others continue to be important as passive policies whereby the central bank, the ECB, is a market maker that accommodates financial crisis. A clear statement that these are market-making, passive, accommodating crisis policies is important precisely so that they are not confused with the other policies, the active policies that I discussed in terms of monetary policy and liquidity, and which are discussed in terms of prices. These ones are about accommodating market making. And having discussed the complementarity of the tools and substitutability in their communication, monetary, liquidity, and lending policy, let me conclude with the fifth and final point, which is a unique feature of the ECB, which is that it has to lead with fragmented national financial markets. Now, most of the time, we argue in the report, this fragmentation is minimal. Well, minimal is not the right word. Is small enough that the ECB can simply focus on euro area aggregates and focus on euro area interest rates as a whole. But sometimes, during financial crisis, that fragmentation increases. And at that point, a central bank should look at risk premium involving assets and securities in different financial markets, and should respond to them and take them into account when it's choosing some of its policies, including using now its menu of policies to potentially try to, at the margin, affect them. This should be seen as an exceptional case because it raises, though, many difficulties, some of which will come now in Lucrezia's discussion of the interaction between monetary and fiscal policy. Thank you.
Thank you very much. Thank you very much, Riccardo. Yeah, and as you said, it's time to go back to Lucrezia now, who's going to pick up the story.
Okay, I'm back. So chapter 3 explores the fiscal-monetary interaction, or if you want, the implication for monetary policy of fiscal and monetary interaction. Now, fiscal policy is relevant for price stability. This may be something that was forgotten, but is very much, in the discussion today, including in some of the communication and speeches of the ECB executive board members. Inflation is always the result of both monetary and fiscal policy. Fiscal policy affects real economic activity. It affects the equilibrium interest rate, so the interest rate that equates savings and investment. And, these have effects on inflation to which monetary policy has to respond. Monetary policy, on the other hand, has fiscal consequences. We call it the fiscal footprint. It affects the cost of servicing debt, the tax base via lending, etc. So in the economic circumstances of the last decade or more, this these issues have become more important. What are these economic circumstances? Well, first of all, now we have large balance sheet central banks. We have large public debt. We have a very low equilibrium interest rate. So in these circumstances, the interactions between monetary and fiscal policy have become more evident, more sizable. And also the case for coordinating monetary and fiscal action for stabilization purposes has become more pressing. So here there are two problems that need innovative answers. The first one is that the ECB fiscal footprint has increased. And, this particular with QE, the monetary policy is having large effects on financial cost. Also, larger balance sheets means larger fluctuations of net incomes and large dividends to treasuries, from central bank to treasuries. So that's the first thing. The second thing is that there is a stronger case now for fiscal activists. At the effective lower bound, fiscal policy is particularly effective on economic activity and on inflation. Also, in presence of sector-specific shocks, so we know that fiscal policy, it's a better tool because we can target it much more than that monetary policy can target specific sectoral shocks. In general, with supply shocks, fiscal policy can ameliorate the trade-off between inflation and output. So with this observation, then, what are the consequences? I want to talk about 4 consequences for the discussion of the future of monetary policy. Well, the first one is very general. So that rigid separation between monetary and fiscal policy, which is embedded in the Maastricht Treaty, needs to be reinterpreted. And, this is a general consideration. But more specifically, we make 3 points. First of all, is that we have clearer rules on fiscal support to the central bank. With large balance sheet and with the maturity mismatch between assets and liabilities, the case of potential losses of national central banks must be considered and must be dealt with transparency. So, what is this risk? The risk comes from the perception that the present value of future seigniorage could become lower than the current stock of interest-bearing liabilities net of assets. The other consequence is that, since we are not a unitary system, we have 19 fiscal authorities and 1 central bank. So when we are looking at fiscal support, we also have to be mindful of what are the rules for sharing risk within the Euro systems. And these rules have to be made clearer, in our opinion. And finally, we need to think of mechanism of coordination between fiscal and monetary policy within the framework of the governance of the Euro area. So let me say a little bit more about these issues. Let me start with the need for fiscal support, point number 2. So we suggest, as a possible solution of the ambiguity now of the rules on the fiscal support in case of losses, as a possible solution, we suggest that the Euro system could call capital according to some rules, okay? Callable capital, in other words. So in case of large losses, both the ECB and the National Central Bank could have the right to require capitalization under clear, strict rules, including prudential management and excluding sovereign default as trigger. Now, it is important in our view that these rules are, in place ex ante, just in case, even if expectation of losses may seem small now. It is important to have these rules to avoid loss of confidence, which may feed inflation expectations, possibly in some contingencies. Now, it is interesting to look at the case of the Bank of England when we are talking about callable capital, because this could be an inspiration for what the Euro system may consider to do. the portfolio of government bond subsidiaries with the bank managers, which the bank manages, but which is indemnified by the treasuries. In this system, all profits made by the central bank are regularly transferred to the treasury, and any losses trigger a payment under the indemnity. So this means that any losses or gains in the portfolio of the central bank are automatically losses and gains of the treasury, and so they are automatically consolidated. This is a model that, it's an interesting model to consider. Now, let me now get on the risk sharing, which is also related to these issues of capital for the euro system. Now, without a euro-wide safe asset and with these 19 separate independent fiscal authorities, we have to be mindful of the geographical consequences, distributional geographical consequences of monetary policy. The composition of QE comes with risk-sharing consequences. And ultimately, what determines the extent of risk sharing is the relationship between the national central banks and their own governments. So, so this is why you have to have clear rules regulating those relationships between the national central banks and treasuries. And today, the rules on the recapitalization of the national central banks, the capitalizations, and the dividend distribution are ambiguous and unclear, but these rules determine the collective support of the euro system, so it's important to clarify that. So it is perhaps unavoidable that there is a little bit of ambiguity in these rules because we are not a fiscal federation. However, this ambiguity, which we call a constructive ambiguity, could be dangerous. And so we advocate, clarifying these rules in order to avoid that the ECB would be designed in a way that it can become a vehicle for large transfers in case of default. Now, what to do? We put down different possibilities. I mean, we advocate clarity. We recognize the complexity of these issues. And so we cannot define different options. At one extreme, the ECB could have all government bonds held by the national central banks. Okay, this would imply no risk sharing, would avoid moral hazard from strategic default. However, it would increase the danger that a member state could be driven out of the Eurozone as a consequence of speculative attacks on that country's government bonds. At the other extreme, if all assets of the euro system were held by the European Central Bank, then there would be full risk sharing within the monetary authority. And this would match the fact that the liability of the euro system are de facto joint liabilities, but it would increase the incentive for strategic defaults. It would de facto create a fiscal union in the central bank's balance sheet, although, as we know, we don't have a fiscal union in the Eurozone. And then we also discuss about intermediate possibilities. So basically, we think that, the Eurosystem, the ECB, they have, to be clear on these rules and decide and explain, what these rules are. Okay, so to avoid, this kind of ambiguity that could be, to lead to instability in certain circumstances. Finally, this is the fourth point, which is the need for monetary and fiscal coordination. Of course, everybody these days wants monetary and fiscal coordination, but within the framework of the Eurozone, it's not clear how to enforce it. So, I mean, we could have gone and, propose ambitious new instruments, but we have decided to make modest proposals within the framework which exists today that regulates the relationship between the central bank, monetary policy and fiscal policy. So we advocate some kind of soft coordination within the framework of the treaty. And for example, we could consider, we think that the ECB and fiscal authorities could consider a new board for Euro area joint monetary and fiscal oversight. This could be, of course, is not a big solution, but is a partial solution And the model could be, for example, what has already been done for the European Systemic Risk Board, which is designed for macroprudential oversight. Now, there is, we could discuss how to design exactly this board. Some principles are important. It would be important that this board would be fed by an independent scientific committee, because it's important to build common knowledge on what is a monetary and fiscal stance and the need for stabilization combining monetary and fiscal policy. The ECB should share it, and then the recommendation, of course, should not be binding for the ECB in order to protect the principle of independence. Thank you, Beatrice. Now it's your chapter.
Yes, and finally, Beatrice, with a slightly different focus for your chapter.
Yes, thank you very much, Tim. I have the pleasure of presenting our work on monetary policy and climate change. Now, as you maybe very much remember very well, there was a big discussion, and in some quarters it continues to be a big discussion about the question whether monetary policy and climate change have any relationship at all. And one of the aspects of that discussion was whether green, in particular green monetary policy in the form of QE, should play any role at all. And the second type of active questions that were being asked at the time when we started the report were the fear of inflation, and it's exemplified by something that Larry Fink said and ended up making headlines when he predicted that the fight against climate change, for instance, in the form of carbon taxes, but also other policies, would lead to high inflation. So those are the two aspects that we consider in this chapter, and I will share a few slides with you to illustrate what we found. So the first one is, should monetary operations include climate considerations? And our answer is, this is not a question of principle, where you have to fight about whether yes or no in principle, but of design. And why is this? Well, simply because monetary operations always have and still do include several instruments and multiple goals. So instruments include, in addition, of course, to the newer asset pricing, collateral policy, credit policies, and they each have several margins which may be affected by climate change or may affect climate change. However, these multiple goals already have a number of trade-offs between themselves. So maximizing monetary policy effectiveness clearly is a goal, minimizing risk to the balance sheet, maintaining operational flexibility, and at the very least, one can certainly also agree on that it shouldn't be contributing to climate change by being biased toward brown assets. So in other words, when you have many trade-offs, smart design matters. And here is an example, which is actually an extract of a table from the NGFS, which a report that they published this year, and is purely illustrative because also they are saying this is a first approach, where you have, for collateral policies, different types of actions that could be taken, from haircuts, negative screening, positive screening, and a first evaluation of how they would rank across these different goals. And the fact that there is no one column that is all green or all red shows clearly that smart design will matter in quantifying first these trade-offs and then deciding on how to deal with them. And arguably, the roadmap that the ECB has announced has many elements of doing exactly this over the next 3 years, deciding which margins matter and why. So then let me move to the second question. What about the inflation scare? How in particular, and this is our focus in this report, have CO2, is the prospect of CO2 taxes fueling inflation? And First, we look at what has happened with past CO2 taxes, and we use several methods, synthetic control method, and also following a previous study by Metcalfe and Stock, who looked at GDP effects of carbon pricing. And let me give you the answer in a few words. What we find pretty consistently is that for the past, at least, CO2 taxes have not been inflationary, and there has been a tendency for them to be even slightly deflationary. In other words, and this is also, we can show that, energy prices did actually go up, but non-energy prices tended to go down, so relative prices changed. And what I'm showing here is the chart, which is not in your report. You have a similar one there. This is a more recent one for the 15 European countries, and you're seeing how the price dynamics for the countries that did introduce carbon taxes. That's even, it's quite a number over the last 30 years in Europe already, has been more muted than in the control group. Now note that this is an analysis for given monetary policy, because we do not expect that monetary policies did react to these carbon price introductions. And when it comes to the euro area, it definitely, and individual countries are imposing them, there is even less reason to expect that they would react. So monetary policy may have played a role in this outcome, but this is not something that we can demonstrate with this kind of analysis. We look now to the future, and how would future CO2 taxes affect inflation and the rest of economic variables that we are interested in. And for this, we turned to our co-author, Warwick McKibben, luckily a co-author, but not quite a coincidence, because he has a big global multi-sector model, which has already been used to evaluate climate shocks in the past, but not necessarily been adapted for Europe, and not necessarily to the question of how monetary policy would respond. So he was did align the model in order to be able to implement a experiment of a €50 carbon tax in Europe alone, not in the rest of the world, and then look at what the consequences in Europe would be under 3 different monetary policy rules. I'm not going to go into them. You have short descriptions in the chapter itself. Just focus on 2 findings on inflation and output. You see that the results here are pretty clear. It depends. What the message here is, monetary policy reactions matter. And these are what you're seeing is the 3 different monetary policy rules I was pointing at. For instance, HS is a monetary policy rule that would respond pretty hawkishly and would in fact lead to deflation in the short run, while also exacerbating the negative output shock. Whereas the modified HS Hartmann-Smets rules that we have that we explain further in the report does the opposite. So it is quite sensitive. Monetary policy matters is the main takeaway. Another takeaway from this analysis is that the short run effects may be quite significant, but if you look, for instance, in particular at the GDP graph, it also shows that carbon taxes in all of these simulations end up having a negative GDP effect. And the long run effect, therefore, on that score is probably the more important one. And that suggests that the need to consider monetary policy and climate policy, and ultimately also fiscal policy, because a lot of these outcomes matter on how the revenues of the carbon taxes are used, and whether there is, for instance, at the same time, a big investment program by using these carbon taxes. All of that has also been simulated in other implementations of Warwick's model. The bottom line is monetary policy matters, and climate policy can matter a lot for monetary policy. These interactions will need to be explored much more in the future. So here, clearly, in the whole area of monetary policy and climate, this is much of it is work in progress. The roadmap of the ECB, as I already mentioned, is ambitious and extends pretty much into the next few years. Therefore, it will need more research, as we always like to say, but this time it's really true. There is also, however, quite a bit of pressing need for this, because we don't have all the time in the world to get to the bottom of the problems of climate change. Last word that I cannot resist saying: you may have noticed on the cover of the report and our slides that there is a bird. And we did not think very hard about that. It appeared because our office really liked the picture. But you will have noticed that it's not a dove and it's not a hawk. In fact, it's a goose. And when I first thought about it, I said, okay, so what about geese? Well, it turns out that it's one of the most underestimated birds, because they are highly intelligent, in particular, high social intelligence. So I think it is the right bird. Thank you, Tim, over to you.
Thank you very much. Well, that told me I called that a duck earlier on, but what do I know? I live in London. So anyway, thank you very much, everyone, and thank you very much to all our panelists for keeping so well to time. That is terrific. I think that's a CEPR record. Okay, so first of all, let's get some questions in. I suppose because there's not too many of you, if I try to direct the questions where they would be most appropriate, as in where they, whose presentations they first originated from, and then anyone else who wants to talk, you stick up your hand, or we can use that little yellow hand thing at the bottom, but normal hands would be good enough. I'll see that. But the first one I really want to put to you is Piroska, who says, she calls your report outstanding, but the question is, why do we have this shadow report? Why are you not directly providing input to the ECB's report, or are you disappointed that some of the issues you wanted to bring up didn't make it into that report? Lucrezia, if I bring that to you first.
Yeah, I mean, I raised my hand because I think this is a very good question, and thank you for asking it, Piroshka. But we did actually provide input to the ECB, because as individual academics, we were asked, to give a number of presentations and so on. And there is a lot of correlation amongst ideas, and the ECB has terrific researchers. As you will see by these papers that they have now produced, which is the background work to the strategy. So, I mean, there is, as it should be, a lot of interaction between the academics and the ECB staff and the ECB, policymakers and the Eurosystem policymakers. But it is very important that academics also have a voice as independent observers. We are not constrained by policy constraints and so on. So I think that, this is a big motivation of having a report which, has an independent life, and also to continue to monitor, or, also in the future, we plan to, to continue to have different set of academics, following and monitoring the ECB.
Can I ask a follow-up one for that then? Is there something in this report that is sort of too sensitive for the official report?
Well, I mean, I don't know. I mean, what I can say what I think, but please go ahead. I mean, I think that, the ECB, for example, did not really cover too much the future of the operational framework. Okay, so that this is probably because it's very sensitive on a number of issues. Okay, and also how large the central bank's balance sheet should be, in the future. How should we understand the balance sheet? I mean, these are all issues that are there to stay, and I think will be tackled in future reviews. On the fiscal and monetary, I've just read the background paper that they have produced. Of course, they don't make any proposals, although they have a brilliant analysis on what are the problems, which is very similar to ours. But then, when it comes to proposals, then of course, I think that make more constraints. But there are other issues as well.
Okay. Does anyone else have some comment on that? Yes, Beatrice.
Maybe I just want to also reiterate that what Lucrezia was saying, of course, we all have our interactions, and in some cases, very straight ones and very tight ones with ECB colleagues. But one of the important functions of CEPR has always been to provide a platform for academics to come together and to write independent research-based policy papers. And in the past, this has been very important as part of the debate of the construction of the euro area, or more broadly of the European economic architecture. And this is really something I care for deeply, that CEPR has this function and that we continue providing these kind of platforms and reports. And it is special. We are now 4 of us sitting on this call. There were more on this group. It is special if you write together. It is more difficult than if you everybody writes their own thing, but it also has potentially more impact. And in terms of the content, I think there are things that are just also complementary to what the ECB did and published, and things that go beyond simply because they are interactions with monetary policy and fiscal policy are not narrowly within their purview.
Thank you. And I want to put Didier Douré's question, because it's the most upvoted one. So Beatrice, stay on for a second, because he was making the point that climate change is an objective totally out of the scope of a central bank still. And I'd like to get a couple of your opinions on this. Is climate change absolutely going to be forever within the scope of monetary policy?
I think I have shown that there are several dimensions in which, ignoring climate change, you will just make mistakes. You will make mistakes in your setting of monetary policy if you don't have climate change properly incorporated and climate policies properly incorporated into your macro models. That's number one. And you will see that the risk profile of your assets and maybe influenced by climate change, all supervisors are now forcing climate stress testing for balance sheets of the whole financial sector. So that's the very least you can say that central banks have to do, at the very minimum, that themselves also. So already there you have 2 dimensions where it's super hard to argue that central banks should not take climate change very, very seriously. And then there is the one that is probably what you're referring to, saying, oh, okay, but in terms of their asset purchases, they should really stay away from any kind of climate considerations. Well, then you just end up buying brown assets, because that's what's been shown, that when you buy a certain portfolio that is market neutral, it ends up being brown. So you are affecting climate change, but in a negative way.
Klaus, can I get a comment from you on this? Because you did talk a little bit about the difficulties of trading off policies.
Yeah, that's right. So I agree, I think, with what Beatrice said, but obviously monetary policy in itself cannot solve the climate problem. I mean, we are not pretending this, and we shouldn't get the impression that by putting it on a central bank's agenda, there wouldn't have to be policies in other areas, like in CO2 pricing and others, and that is certainly not our intention. If that were the impression we give to the public, that would be certainly a disservice. The other thing is, of course, that we have very little understanding of how the introduction of new green products will affect actually the measurement of inflation, because it will largely depend on how statistical agencies will treat the new products. I mean, they could say a green produced product is a new quality, and therefore the price increase associated with a green product relative to a brown product represents a quality progress. It would not get accounted into inflation, or it could be treated as a comparable substitution of a product that serves the same function of the one that it substitutes, and then it would get recorded into inflation. And these things, need to be sorted out, especially because the treatment of quality change across the European Union by statistical agencies is very heterogeneous. We have seen this from the microprice data, and there are a lot of issues related to climate change that need to be factored into monetary policy.
Now, can I ask you and Ricardo the question on this? I'm going to abuse my authority and put one of my own in. Does this not, and this and other factors that you've introduced here, massively complicate the job of central bank communication? And could you go into a little bit more depth about how central bank communication might change in the future? Klaus?
Ricardo, do you want to take this?
Yes.
Sorry, I thought Klaus was going first. Sorry, Tim, I got confused. Absolutely, communication is an important part of a central bank. After all, much of what its power comes from affecting expectations, either directly or even affecting expectations through them asset prices and interest rates, and through those the rest of the economy. At the same time, so communication is important. Communication is a big part of central banking. At the same time, communication difficulties, as you describe them, are precisely that, difficulties, things that have to be addressed, things that are to be dealt with, not things to shy away from. In the report, as I was talking about the operational framework, it is certainly much harder to discuss communication and to communicate how one is setting forward guidance, deposit rates, size of the balance sheet, and potentially other policies. That is not an excuse, though, to not use those levers, to not use those policy tools, but rather simply a pretext, a requirement to come up with a clear framework that integrates them and that makes that communication easier. And so in the part of the report that I was presenting, it was clear that communication was harder in what we were discussing than it was in 2005. But as I said, that is the new normal. And not having a framework to communicate, that really makes communication easier. Likewise, when it comes to the climate change that spurred this question, as well as I might say other objectives, like Klaus and Beatrice both mentioned, simply pretending that there are no climate consequences and effects of the central bank actions, and or pretending that the central bank has no responsibility whatsoever towards what is today a very large component of what societies want us to care about, as expressed in their choice of political power, is also not in itself an option. The question then is to, as we express in this report repeatedly and already in the answers, to rather clarify what are those trade-offs, study them, and communicate them. To make clear, like Klaus was saying, that this is not in any way the main mandate of the central bank, while at the same time noting how like Beatrice was saying, that some central bank actions will be purposely or not have brown consequences, or will be making some problems along the dimension worse or better. It is in our report, by being transparent, but more than transparent, really, by communicating those trade-offs and those implications and consequences of central bank actions, that I think we can have a more credible central bank, a central bank that, while always acknowledging its limitations, is also considering, discussing the trade-offs that its actions impose in society, as it should, because after all, a central bank is an agent, is an institution of the state that is here to serve the social welfare. And if the people care about climate change, the central bank has to care about climate change, even if it is not its main responsibility. And communicating that, Tim, I think, is a difficulty, not a reason to ignore the topic or sweep it under the rug entirely.
Yeah, sorry for.
I would add, sorry. I mean, in a way, I mean, all central banks have abandoned the strict inflation targeting framework and adopted some kind of form or different form of flexible inflation targeting. And I think in chapter 1, one of the points that is made is that the horizon of that kind of flexible framework should be linked to, to the secondary objective of central banks. And, so this is, this is actually an attempt to provide a framework that can be transparently communicated on how to relate the primary objective to the secondary objective. And by secondary objective, we mean employment, climate, and others. But Klaus, sorry,
I just wanted to say, if you have a coherent framework within which you can talk about these multiple objectives, this should make communication easier. But it is not that is one provided as such in the review. Instead, it pretends that we can achieve all those things and at the same time have no effect whatsoever on the price stability objective, which I think is a bit of a Potemkin's village. It is not really there. And it is also potentially dangerous because when then facing down the road some trade-offs, say between climate or price stability or between financial stability and price stability, and then as a result of that, perhaps choosing paths that lead to some deviation from price stability as a necessity maybe, or being forced to embark on that road, it will generate credibility issues. And these credibility issues can be easily handled within a pre-communicated framework that explains exactly the limits within which such deviations would take place and the extent to which certain things would be factored in or not. And I think that is maybe one of the biggest shortcomings of the review, that it doesn't provide that.
Stay on a minute, Klaus, because Didier's other question is he's asking what's the deep root between the inflation undershooting since 2012 and can the ECB draw conclusions for the future from knowing what that is?
Right. So, I mean, that is, of course, a very complex problem.
It's an entire webinar, isn't it?
Right. So, but of course, I mean, there are a number of lessons. It is perhaps no coincidence, that there were a number of adverse shocks that, that would lead, to an undershooting, even if the policy were perfectly symmetric, credible, and well done. So the extent of the undershooting and the persistence of the undershooting is, of course, worrying because it says despite the extraordinary tools that have been deployed and that have been proven effective at influencing the risk-free interest rates on the long end of the yield curve, they have had perhaps very little effect in bringing inflation up. We don't know because we haven't seen the counterfactual, but the evidence on these tools being so effective is scant and very uncertain, as we show in the report. And that, of course, could have had implications for, going forward in designing a strategy that seeks to stay away from the lower bound and perhaps a situation where tools become less effective in influencing inflation.
Okay, great. There's a couple of...
I wanted to pick up on that because actually we spent quite a bit of time in the report trying to explain why there was some undershooting. And of course, I mean, many central banks around the world, were facing, the decline of the equilibrium interest rates and therefore the limited and the issue of the zero lower bound. But what has to be explained is why the ECB undershoot more than other central banks and since 2012. So, well, first of all, there were some policy mistakes that were on one hand targeting, paying too much attention to headline inflation rather than underlying inflation. And, this is something that now the ECB seems to have corrected in their own strategy. So that's very welcome. Interest rates were increased in mid-2011 in the middle of the debt crisis. So there was also an under evaluation of how financial factors were actually affecting inflation and output. But also after the famous whatever it takes in July 2012, where the kind of the big risk of some countries default was removed. Inflation, since then started declining because there was a big delay in implementing the whole set of possible tools. As Klaus said, there is little evidence of how those tools are effective, but there is also evidence, which we report in our report, that the market was very much confused about what the ECB was doing, and that that the announcements of the ECB policy announcement were met with kind of volatility in the market, and only after QE was introduced in 2015, then we had this kind of the volatility kind of decline. Now this after 2015, we can say that the ECB became like a normal central bank, okay, starting using all possible tools. But at that point, there was quite a bit of time lost. And I think that you could see that, inflation expectations had started trended down since 2012 in a very persistent way. So policy mistakes are actually costly.
Ricardo, I think this one's for you. It's Luca's question here. I missed the relevance of setting the DRF rate as the key policy rate in place of the MRO rate. Do you mean that excess reserves should say structurally large, or why? That is yours.
Telegraphic answer, yes. What we meant is exactly excess reserves should stay structurally larger, approximately so, because for the reasons mentioned in the question. So telegraphic answer, yes, that's what we had in mind, a somewhat larger balance sheet. Let me add two telegraphic answers to the previous two questions as well.
Yes.
2012-14, Lucrezia spoke about the policies, Klaus about the outcomes. In between them, the fact that expectations of inflation drifted further down in the Eurozone between 2014-15 than they did elsewhere. And I think partly for the reasons that Lucrezia mentioned. Third telegraphic answer, on this consideration of trade-offs and climate change, I refer everyone to read precisely the chapter 4 in our report, which exactly gives an example of how changes in changes in some policies relating to carbon taxes affected inflation, how the trade-offs, how that then affects how monetary policies must consider the trade-offs in terms of price stability objectives. And again, in a somewhat transparent way, ends up trying to see how one could consider climate impacts and climate policies as they relate to the price stability objective and the trade-offs it creates. So it is possible to communicate and talk about it. And I think it would be strange if the central bank didn't do so in terms of not just in terms of in interactions with the price stability objective.
Great. Stay on, Ricardo. I've got a new normal question for you. Piroska's come in with that. The currency swaps. The ECB played a helpful role during the COVID crisis. And should this now be part of your new normal?
Again, telegraphic answer, yes. The ECB did very well, I think, during this last COVID. During 2020, as opposed to 12 years ago, in realizing that these swap lines are part of one of the things that I mentioned when I talked about lending programs that sometimes have to be activated as a market-making response when there are disturbances in markets, and that was a clear example of it. And I think in my view, I think we did discuss this report. They were mostly effective and seems to have worked just as they should have in 2020.
Lovely. I think we're more or less out of time. Yes, we are just about on time now. So fantastic. We've got through a load of work. There is actually a lot more in the report as well. And a lot of these questions are covered in more detail than we have time for today. So make sure you do the download on that report. Or alternatively, you could come back where we are back on for another webinar, and it's on the 7th of October. It's 9:30 in the morning UK, 10:30 Europe. Set your alarm clocks, I guess, for that, where there will be a panel discussion which focuses on the market-oriented issues that are covered in chapters 1 and 2 of the report. So plenty more discussion and hopefully a lot more questions from you as well. But now, as our time is up, it just falls to me to say thank you very much to our panel, Lucrezia, Ricardo, Klaus, Beatrice. Thank you ever so much for your contributions. Thank you to all of you who provided questions. We hope you liked what you heard and saw today. Let us know, because your comments come to us and we try to do more of what you want. Meanwhile, enjoy the report, and we will be back soon. From me, Tim Phillips at the CEPR. Goodbye.
Goodbye.
Bye.